Hello and welcome back to Armbruster Capital Management's Invest Ed VidCast series. I'm Chris Cibula and I'm here with Mark Armbruster. Today we're discussing gold. The COVID-19 pandemic resulted in a government-forced shutdown of much of the economy and subsequently very large government stimulus packages from nations around the world. This has amounted to literally trillions of dollars being pumped into the economy, including $6 trillion in the U.S. alone. Worse, this comes on the heels of huge government spending to help bail out the economy after the 2008 financial crisis, much of which is still sloshing around the global economy. Many economists fear that all this excess liquidity will result in rapid inflation in the years to come. Popular wisdom suggests that gold is a solid hedge against inflation, and the price of gold has indeed risen recently. We fielded a number of questions from clients lately about buying gold in their portfolios, so we thought we would address that. Mark, what do you think? Should we be buying gold today?
I don't think most investors should ever be buying gold.
Why is that?
On its own merits, gold's value as an investment is dubious at best. The long-term returns of gold have been roughly in line with the returns of cash. Gold is outperforming cash currently, but there have been long stretches when it underperformed even one-month treasury bills. This is not terribly surprising because gold is often considered a currency, or at least a currency surrogate. However, gold is far more risky than regular currency, and it's experienced higher volatility than even the stock market. These characteristics don't make for a great investment. Low returns and high risk are the opposite of what investors need.
I get that, but with all the money printing by global governments over the past several years, inflation is a real concern. As governments add more paper money supply, the value of their currency declines relative to foreign currencies. But because many nations have been engaging in this currency debasement, gold should rise as the last stable store of value.
That's certainly true, but despite the common wisdom, gold hasn't really worked well as protection against inflation. In order for an asset to be an inflation hedge, it has to either provide returns that exceed inflation over time, or it has to move in alignment with inflation. Returns from gold have generally exceeded inflation over time, but just barely, and it has had very long periods, up to 20 years in fact, when that has not been true. But even for investors with very long time horizons, other asset classes do a much better job. Stocks, real estate, and even high-quality bonds have provided long-term returns that are in excess of inflation and gold. What's more, the correlation of gold with inflation, as measured by the Consumer Price Index, is actually quite low. So when inflation rises, gold will not necessarily follow suit. Gold significantly underperformed and indeed lost money during the decade of the 1980s when inflation averaged over 5% annually.
What about gold's track record as a hedge during periods of market stress? For example, during both the 2000 to 2002 and 2007 to 2009 bear markets, stocks declined over 45%, while gold shot up in value. That is actually a very good characteristic. When you need diversification the most, gold proves its worth.
That's certainly true, but gold's track record isn't perfect even during these periods. Gold didn't do well during the bear market in the early 1970s, and interestingly, for a globally recognized asset, it can be dependent on geography. For example, if you're a Greek investor, you saw your stocks decline by over 50% from 2012 to 2015, and that was a time when gold prices declined by over 37%.
Yeah, but you have to admit that gold does have some positive attributes for protection against economic disaster.
You're right, I do admit that. Disaster protection is the reason we hear cited the most by investors interested in gold. Some people are genuinely afraid of a true economic meltdown. They want to hold small increments of physical gold at home in a safe. They reason that this will allow them to buy goods and services when fiat currency, like the paper-based US dollar, no longer has any value.
Right, and I agree with them, but I also think that this is an inadequate measure. Living in the city or suburbs when there are no government services, no open grocery stores, and no functioning utilities is probably not practical. For those who truly want to hedge against an economic catastrophe, farmland, canned goods, bottled water, a few cows and some chickens, and a whole lot of physical effort will be required to ensure survival. And yet, we rarely get phone calls asking about the best way to purchase these items.
Yeah, it's true. One last thought for those who are still determined to buy gold. The price you'll pay is very significant, and physical gold may not have the desired liquidity you want. I've shopped around to the various vendors of physical gold bars and coins. There are usually very significant commissions to both buy and sell. It's not unusual to have to pay 10% or more of the spot price of gold on a purchase and to have to accept a 10% discount upon selling. So just to break even, gold would have to rise 20%. Additionally, there may be storage or insurance costs that are also part of owning physical gold. These costs, which work against your profits, need to be included when calculating your overall return. You can avoid the costs and liquidity issues of owning physical gold by using a fund, such as an exchange-traded fund, and those often have direct exposure to physical gold. But it's important to note that in either event, capital gains on collectibles that are held more than 1 year are taxed as ordinary income. This could be double the long-term capital gains tax rate for other types of investments, which again provides a headwind for investors.
So, gold has been an accepted form of value in exchange since at least 700 BC, when gold coins were first produced. It was mentioned as a source of wealth in both the Bible and Iliad, and it was cited in texts dating as far back as 3100 BC, during the first Egyptian dynasty, as a valuable asset. But here at Armbruster Capital, we're not huge fans. A reasonable person could make an argument for a very small amount of gold in an investment portfolio, but it would be hard to justify more than a 5% allocation. Gold is volatile, pays no dividends or cash flows, and has no intrinsic value. So despite centuries of precedent to the contrary, we think investors are better off leaving gold alone. Thank you for joining us today, and as always, feel free to reach out to chat further about gold or any other investment topic.